So I'm carrying on with the Tax 2601 Assignment 1 for 2018. Currently I've answered all the theory questions relating to Chapter 1 and 2. I'm going to be now looking at the questions that we haven't looked at quite yet. Question 10 was the case New State Areas Limited Commission for Inland Revenue. In terms of ruled, which court was that? When having gone through the study guide, I actually looked at the second textbook, which was this one, and I had searched New Areas State, and it actually gave me it here. You can see that this is actually in the second book, which is actually chapter 5, which is looking at capital versus revenue. So I don't know why they're testing chapter 5 content, which is learning unit 5, in the first study guide assignment, which is quite unusual because you would have had to have covered chapter 10, chapter 5 rather, sorry, to do question 10. And that's what I found here when searching for it. So if we had to answer the question, we're looking at the difference between capital versus revenue. This case, New State Areas Limited versus CIR, was from the SATC, which is the South African Tax Court. So to answer this particular question, two would be the right answer for this one, but this is only covered in chapter 5, well, study unit 5. Okay, so a little bit ahead of time in terms of testing content that's slightly beyond the scope of chapter 1, 2 and 3. Okay, then we answer the rest of the questions here. 18 is the CC tax liability, so let's go to that one. There's 18. Kloof Cafe CC qualifies as a microbusiness and is taxed on the turnover-based tax system for the 2018 year of assessment, ending that in a taxable income and taxable turnover of that and that. What is the tax liability of the CC? They qualify as a microbusiness, so when I go to my tax tables, I'm going to be looking for microbusiness. Companies, SBCs, there we go. Tax turnover for microbusinesses. With a microbusiness, you're going to be using the taxable turnover. Just be careful with that, not the taxable income. So it had taxable income and taxable turnover of that and that respectively. Taxable turnover is 755. That's important. Seven 55000 is the taxable turnover. All I'm then going to do is literally take the information from the budgeted tax guide, and I'm going to be looking at the taxable turnover, which is 755, which is in the last line. That one there. And I'm going to do the calculation. So the amount above 750,000 is equal to that minus 750,000, gives me 5,000, times it by 3% gives you an amount of 150. Add the 6650 gives 6,800. Is 6,800 there? Yes, it is. Option 3. Question 19. Kloof Cafe estimates that its taxable turnover for the 2019 year will be 900,000. What is the amount of the first interim payment in respect of turnover tax that must be submitted to SARS in respect of the 2019 year of assessment? And when must this payment be made? You must use the 2008 tax tables. Okay, so question 19 requires this. First provisional tax payment. We are only going to be looking at this in chapter 3, so I will cover this in detail. I'm just going to give you some general scope now so you have an idea of how to approach the question. Calculation of the first provisional tax payment. You need to determine the basic amount. Then you need to calculate the normal tax on that amount divided by 2, and then you get the first provisional tax payment. Remember, SARS wants to collect taxes sooner rather than later, and that's why they incorporate provisional income tax. You have to go back and you then have to look at this, which is looking at the basic amount. How do I get the basic amount, which is then going to be used for the first provisional tax payment? So that's the theory that we'll look at in chapter 3. Right now I'm going to be applying it to this scenario. So we go back to the question. Kloof Cafe estimates that its taxable turnover for the 2019 year assessment will be 900,000. Notice this is for the next financial year. Then they said, what is the amount of the first interim payment that must be submitted to SARS in respect of the 2019 year of assessment, and when must this payment be made? You must use the 2018 tax tables. Okay, so they don't give you a choice here in terms of what the basic amount should be. So I'm going to be working out tax on 900,000 for this CC. This CC is going to be paying tax in line with the company's income tax. We'll be paying that at 28%. So 900,000 times 28% equals. Okay, this was the SBC. We would use the SBC tax tables. This isn't, so I'm going to times it by 28%. Gives me the 252,000. That's 28%. Taxable turnover. What else do we see here? Must be submitted to SARS. You must use the 2018 tax tables. That gives me that, which they don't say this is an SBC, which might be problematic. They say what amount of the first interim in respect of turnover tax. Okay, turnover tax. So then that's probably indicating that this is a micro business. If that's the case, we're going to use these tax tables. So just be careful here. Asterisk turnover tax is referred to in the question. So then assume micro business. Right, so if it's a micro business, I'm going to be using that equation again, which is what I had above here as well. So I'm going to do the same thing again. Above 750,000 equals 900,000 minus 750 gives you that, times that by 3% gives you gives you that, add 6650 equals 11,150. So go back to the question, do we have that? Yes, we do. 11,150. Right, and because this is the first interim payment, remember the first interim payment is going to be made 6 months within the year. So maybe just to show you that theory in the actual study guide, in chapter 3 you will see here they give you an example of when the interim payment is going to be made. Note, looking at the interim payments for a provisional tax income payment, the first payment is going to be made on the 31st of the 8th, 2017. The year is not important because this will vary year by year by year. Here, sorry, not there, other page. Here, 31st August 2018. Okay, for the 2019 year of assessment, because that's the current year that we're looking at. So option 2. And that covers question 19. What other questions do we still need to look at? Question 22. There's question 22. This is looking at the first provisional tax payment again. So very similar to what I just discussed. If N was last assessed in 2015 with the taxable income of that. The taxable income submitted for 2016 and 17 was this and that. The company has a 30 December year end. Their first provisional tax payment for the 2018 tax year is due on the 30th of June 2018. On which amount must they base their first provisional tax payment? So again, this is looking at the basic amount. Earlier I just spoke about the theory relating to chapter 3, which is looking at the basic amount for the provisional tax payment, we are going to have to apply that here because we're looking at the current first provisional tax payment having been given the 3 preceding years. So if I pull that information through, number 1, the taxable income assessed by the Commissioner for the latest preceding year of assessment less capital gain. Well, if I look at the information here, preceding year to 2018 will be 2017. We've got that, which is 920,000. Here they said the basic amount is used when calculating both the first and second provisional tax payments. The basic amount is deemed to be as follows. Number 1, this. Okay, preceding year of assessment, which we've got, which is 920. The latest preceding year of assessment is deemed to be the assessment relating to the preceding year of assessment, which we've got, and obviously if there's 14 days before the date at which the current provisional payment should be submitted to the Commissioner. So do they give us the exact dates here? No, they don't, so that wouldn't be applicable. That's fine. And then 3, the basic amount must be increased by 8% per annum if the basic amount must be calculated more than 18 months after the preceding year of assessment. Okay, and it is in respect of a year assessment that is more than a year after the end of the preceding tax year. Right, so that's the theory relating to provisional income tax payments. Just want to show you something else as well here. There's it. So the provisional tax payment calculation of the first provisional tax payment determine the basic amounts. So the big issue that we're looking at here is what is the basic amount. So the basic amount is deemed to be as follows. Okay, you've got these 3 options that you can apply when calculating or determining the basic amount. So looking at this question, assessed in 2015, you should be looking at the greater of because you want to be in line with what you've assessed. So let me just show you the okay, there we go. In the case of employees tax, the government cannot okay, that's collection of taxes and entities. First provisional income tax, I just want to show you where is that point. They don't give it to you here, so it must be earlier on. There we go. Okay, so this is an example. First payment, estimated taxable turnover times the applicable taxable rate divided by 2 gives you the first payment. There should be more background information around that. Small businesses, corporations, companies and dividend tax, partnerships. Okay, they don't, which is a pity because obviously the basic amount needs to be estimated correctly. So you need to use the amount that is considered to be larger, because then at least you've got an amount that would apply to the particular company that will allow them to pay the correct amount of tax to avoid situations where they are understated. Here, microbusiness taxable turnover, this is looking at twice a year. That's fine. That's fine. There's the first payment. And yeah, that's it. So looking at that, based on the basic amount, the basic amount here would be the taxable income in the preceding tax year. So that would be the taxable income submitted for 2016 and 17 was that. The company has a 31st December tax year. The first provisional tax payment of 2008 is due on the 30th of June 2018. On which amount must they base their first taxable provisional payment on? I would use the 920,000. Option 2. Okay, see chapter or see study unit 3. Right, then we've got the last three questions here looking at the calculation of provisional income tax. There's it there. Question 27. A company not a SBC as defined must make its first provisional tax payment on 30 June for the year of assessment ending 31st December 2018. The latest assessment received was in respect of the 2017 year of assessment, which is last year, and that was on March, okay? And it reflected a taxable income of 1.2 million. The 2016 tax assessment reflected taxable income of 867,000. Alright, so the preceding year would be the basic amount. And the basic amount here, this is for the 2018 year, so 2017. 2017 amount is 1.2 million. Alright, and I'm looking at what? Not an SBC. So if it's not an SBC, is this a micro business? Do they say anything about tax, turnover tax? No, they don't. So times it by 28% gives you the tax amount, 1.2 million, times 28% gives you 336,000. What is the provisional tax amount that must be paid by the company? Divide by 2. $168, option 2. Question 28. Apply the same set of facts as in question 27, except assume the latest assessment in respect of the 2017 year of assessment was received on 21 June and not March 2018, and it must be paid on the 30th of June. Okay, so when you see that, that basically talks about the basic amount in terms of the 14-day rule here. So they said the latest preceding year of assessment deemed to be, okay, where notice was issued more than 14 days. Right, if it wasn't issued more than 14 days, this means that if the assessment, if it was received 14 days before the first provisional payment should be made, then the assessment can't be used for the calculation of the first provisional payment. Then we're going to have to use something different, okay, which is the next bit. So let's have a look at that. Apply the same set of facts as question 27. So let's go back to 27. There's it. We don't have, well, this 1.2 million would have received, but that was not within the 14 days, so not later than that or more than that. So then we would have to use the 2016 tax amount, which is 867. Right, 867 is what I'm going to be using. The basic amount must be increased by 8% per annum if the basic amount must be calculated more than 18 months ago. Is this more than 18 months ago? Well, we've got 2016, so 17 will be 12. 18, that will be the 30th of June 2018. So 17, 18 will be 2 years. Is that right? Let me just check the dates again. 2016 year of assessment. Okay, if it's 2016 year of assessment, more than 18 months after the preceding assessment. Well, when was the preceding assessment? Preceding assessment was in 2017. 2016 would have been 12 months before that. It's not more than 18 months, so I wouldn't adjust for it. I would just use that amount as the preceding year of assessment, which will be the basic amount. So the basic amount is what I'm going to be using here. 867,123, right? And I'm going to be calculating tax on that. This was question 28. Is this no, it's not an SBC, so just times it by 28% again to get the tax. Alright, divide that by 2. And that gives me 2138. So option 4. And then the final question, question 29, a closed corporation, not an SBC, is defined okay, needs to make a second provisional tax payment for the 2018 year of assessment ending March. It is estimated that the taxable income for the 2018 year will be that, and its basic amount from the last assessment received from SARS for the 2016 year of assessment is that. Okay, so obviously I'm going to be using the 2018 estimate, but remember, that's the second provisional tax payment. So just be careful with that. I need to refer to this, just to show you guys what I'm referring to. Second provisional tax payment, calculation of the second provisional tax payment for a taxpayer with taxable income of 1 million or less. Start with the low of the basic amount or the estimated taxable income. So do we have that scenario here? Yes, we do. It's less than 1 million. So then I'm going to be using the lower of the basic amount or the estimated taxable income. Estimated taxable income was 770,000. The basic amount in terms of the last received assessment, which was 2016, was 560. So I could use estimated income tax or the low of the basic amount. Remember the basic amount, just to go back just to show you this, there's the basic amount in the preceding year, okay, and assessed by the commissioner. Right, latest preceding year of assessment is deemed to be within the 14 days. So here, the previous year of assessment, if we're looking at 2018, would have been the 2017. They said make a second provisional tax payment for 2018 year of assessment. It was estimated the taxable income for 2018 year amounted to that, and its basic amount from the last assessment received from SARS for the 2016 year of assessment was, or is, 560. So I would use the 560 here. But let's just double check that. The taxable income assessed by SARS for the latest preceding year of assessment, less capital gain. So here we've got the estimated taxable income for 2018. The basic amount from the last assessment received from SARS for the 2016 year of assessment. So 16 would have been 1617, and then we'd had 1718. So you would have to use the 560 because it's the lower of. Okay, that's fine. So that would have been 560, option 3, lower of the two, okay, as per the second prov payment. See study guide. Okay, and that concludes the assignment. I've now covered all the questions. Let's just double check. That's done, that's done, that's done. That's all done. Perfect. So I'm going to save this and I'll send this through to you. Thanks for watching. Goodbye.